Market watch this week. Why is this week so important? The Fed needs to make a decision, and soon. We have a slew of economic numbers expected this week, probably the biggest numbers we've seen in a while, and we're in a very precarious position. Now, of course, we have the FOMC meeting schedule. We've already had the January through May meetings. We're expecting the June meeting very shortly. And the Federal Reserve really has to make a decision as far as whether they want to lower interest rates or not. But they can't delay forever because we are also in an election cycle. And the perception is that if they cut rates very close to the election, that could appear to be political. This is from Business Insider. The Fed's timing for interest rate cuts won't have anything to do with the presidential election. That's what Chairman Powell says. In particular, our analysis is free from any personal or political bias in service to the public. We will not always get it right. No one does, but our decisions will always reflect our painstaking assessment of what is best for our economy in the medium and long term and nothing else. So essentially, Chairman Powell is saying, listen, if we need to cut rates, we will. If we don't need to, we won't. But the fact of the matter is, if they cut rates very close to the election, that could look political. Obviously, they want to avoid that appearance. Well, this is where the Fed funds futures stand right now. In particular, September is our pivot point. The blue bars represent the probability the Fed will not cut rates. That stands at 50%. The green bars represent the chance that the Fed will cut rates by a quarter point. That's at 45%. A half a point cut at 4.5, almost 5%. So September really is the first month we see of at least a 50% chance, and we've been wavering in this area, a 50% chance the Federal Reserve will cut rates in September. Again, they can't really cut rates in November. That's too close to the election. So the Federal Reserve really has to make the decision. Is it going to be June, July, or September, or nothing at all? Well, speaking of which, let's go to this week's economic calendar. Every day we have something very big to talk about. On Tuesday, S&P Case-Shiller Home Price Index. Now, what are we expecting? We've seen a rise over time. Certainly last month's report was good news. But keep in mind, we just had the new houses sold, new homes prices, including new houses sold. The average sales price dropped to $505,000. Remember, we spoke about this last week, that the inventory is rising because of a lack of affordability. Inflation is pricing us out of the market. The big question is, will the S&P Case-Shiller Home Price Index also reflect, exactly this phenomenon? Now, that's on Tuesday. On Wednesday, we have the Fed's Beige book. This is big. Published by the Federal Reserve, it's based on interviews with business leaders and economists. It's published, I believe, 8 times a year. The FOMC uses this to determine monetary policy, and it highlights business activity and employment conditions. What the Beige book says is usually where the Federal Reserve goes. So we look at the Beige book very closely. And again, that's coming on Wednesday. Now, of course, after that, we have Thursday, Gross Domestic Product, GDP. Last month's GDP was a disappointment, 1.6% rate of growth following last quarter's report of 3.4, and before that was 4.9. We're seeing a continuous slide to the downside. Now, again, we look at all of these numbers, the GDP, the new home sales, the S&P Case-Shiller earlier than the GDP this week. And the question is growth slowing enough where the Federal Reserve should cut rates? Is employment slowing enough? There's also another side of the coin. The other side of the coin occurs on Friday. That's PCE, personal consumption expenditure, inflation. Will the Federal Reserve cut rates? Only if the inflation rate declines. Well, last month's 2.7% inflation was a disappointment. It's rising. Will this month's inflation rate come in at 2.7? I believe the analysts actually have it staying at that current level of 2.7%. The Federal Reserve would cut rates if we see inflation decline and or a significant amount of growth decline. We're going to get indications probably in one direction or another. Now, all this is very important. And how do we know upon release of these numbers which way the market is now leaning? We look to the bond market. In yellow, S&P 500. In blue, it's the 10-1 Treasury spread. It's the difference between the 10-year Treasury bond and the 1-year Treasury bond. Now, in particular, we have a negative or inverted interest rates on the spread, meaning that the 1-year Treasury bond pays a higher percentage than the 10-year. It's at negative 0.73. And we've seen over time, and it includes until now, there's an inverse correlation that when the S&P 500 goes up, when stocks are strong, it usually coincides with a 10-1 spread deepening, meaning that either the 1-year bond is going up or the 10-year bond yield is going down. Remember again, short-term bonds like the 1-year, those are very closely correlated with future Federal Reserve decisions. If it's expected the Federal Reserve is not going to cut interest rates, the 1-year bond yield is not going to go down. And that's what's happening right now with the 1-year. Long-term bonds are more closely linked to the long-term economic prospects. Over the long term, are we going to go into a recession? 10-year bond yields will go down. Are we going to recover? 10-year bonds will go up. So remember the difference between the two. Short-term bonds, immediate Federal Reserve decisions, the anticipation of those. Long-term bond yields, long-term economic growth or expectations of growth. Well, in yellow, that's the 1-year bond. In the blue, the 10-year Treasury yield. And the spread is shown between the two. In particular, notice what the pattern is we see right now. The 1-year bond is flat. It's not going up or down. Remember what the 1-year bond? That indicates the expectation of Federal Reserve interest rate decisions. It's flat. The expectation is the Federal Reserve is not going to cut rates. At best, we have a 50% chance they may cut rates in September, but at least at the moment right now, no expectation of a cut. The blue line's trending lower. That's the 10-year U.S. Treasury. Now, that yield's trending lower because over the long term, the expectation is economic conditions are worsening. We just saw the GDP. We're expecting an even lower number, perhaps. We've seen the jobs numbers last month, and by the way, those are coming up soon as well. So that is really the dichotomy between the two. The expectation that interest rates are not going down right now, but long-term economic conditions are weakening. Why does the stock market like this? The stock market looks at the weak data and says, well, if the data is weak, maybe we're going to get an interest rate cut soon, and stocks like lower interest rates. So again, we have a slew of economic numbers this week. Join us. We're going to do our best to cover these in as much detail as possible, and we'll report back to you the most significant news of the day. We look forward to seeing you back soon.